The UK's strong labour data has triggered a spike in short-term borrowing costs, as markets anticipate further interest rate hikes from the Bank of England. In this section, we will explore how UK's interest rates are expected to hit at least 5.5% by December, according to market pricing, and how this could affect the mortgage market, the pension funds, and the consumer spending. First, let's look at the mortgage market. The Bank of England has raised its base rate 12 times since December 2021, from 0.1% to 4.5%, making it the highest level since. This means that borrowers who have variable rate mortgages or who need to renew their fixed rate deals will face higher monthly payments. For example, a £200,000 mortgage with a 25-year term and a 2% interest rate would cost £848 per month. But if the interest rate rises to 5.5%, the monthly payment would increase to £1, that's an extra £382 per month, or £4,584 per year. Higher mortgage costs could have a negative impact on the housing market, as some homeowners may struggle to afford their repayments or sell their properties. This could lead to lower demand, lower prices, and lower construction activity. It could also reduce the equity that homeowners have in their properties, making it harder for them to remortgage or move up the ladder. Next, let's consider the pension funds. Pension funds are large investors that manage the retirement savings of millions of people. They invest in various assets, such as bonds, stocks, and property, to generate income and growth for their members. Interest rates affect pension funds in two ways: by influencing the value of their assets and by affecting their liabilities. On the asset side, higher interest rates tend to reduce the value of bonds, as bond prices move inversely to interest rates. This means that pension funds that hold a large proportion of bonds in their portfolios could see their returns decline. However, higher interest rates could also boost the value of other assets, such as stocks and property, as they reflect stronger economic growth and higher corporate profits. On the liability side, higher interest rates tend to reduce the present value of future pension payments, as they discount them at a higher rate. This means that pension funds that have defined benefit schemes, where they promise to pay a certain amount of pension to their members based on their salary and years of service, could see their funding gaps narrow. However, higher interest rates could also increase the cost of providing annuities, which are contracts that guarantee a regular income for life for retirees. Therefore, the impact of higher interest rates on pension funds depends on their asset allocation, their type of scheme, and their duration of liabilities. Some pension funds could benefit from higher interest rates, while others could suffer. Finally, let's examine the consumer spending. Consumer spending is the largest component of GDP in the UK, accounting for about 60% of total output. Consumer spending depends on various factors, such as income, wealth, confidence, credit availability, and inflation. Interest rates affect consumer spending mainly by influencing disposable income and borrowing costs. On the income side, higher interest rates could increase the income of savers who receive interest payments from their bank accounts or other investments. However, higher interest rates could also reduce the income of borrowers who have to pay more interest on their loans or mortgages. The net effect depends on whether consumers are net savers or net borrowers. On the borrowing side, higher interest rates could discourage consumers from taking out new loans or using credit cards to finance their spending. This could reduce the demand for big-ticket items such as cars or furniture. However, higher interest rates could also encourage consumers to bring forward their spending if they expect further rate increases in the future. This could increase the demand for durable goods that can be bought now and paid later. Therefore, the impact of higher interest rates on consumer spending depends on how consumers react to changes in their income and borrowing costs. Some consumers could spend more in response to higher interest rates, while others could spend less.